of a little bit of easing. What we came off of was tremendous dislocations from that liquidity squeeze that we saw roil through the markets, from the real economy, through the banks, throughout the financial system. You're seeing now the tail end of the efficacy of the Fed's liquidity programs, bringing back some liquidity and normality. And then the bond market is now starting to reflect some fundamentals. You're seeing the story that you guys are describing on the equity side, a lot of the steepening of the curve today, modest moves, modest tightening of spreads is really kind of what you'd expect for those equity market moves. And so we're starting to get back to being able to interpret some of the moves in the bond market for a reflection of the fundamentals and not this, a historic liquidity squeeze that we saw a couple weeks ago.
Anastasia, on down days for some of these big tech stocks, which have very strong balance sheets like Microsoft and Apple, is it a buying opportunity for them?
It is absolutely a buying opportunity, especially for long-term investors. When we think about the environment that we're in today, whether it's the COVID world today or the post-COVID world that hopefully we'll be living in soon, it is the companies like artificial intelligence software companies and the semiconductor companies and the 5G companies that are going to be enabling this transition to the post-COVID world. So one of the things that we're looking at the moment is how artificial intelligence, for example, is at the forefront of actually helping us manage and navigate this pandemic. So our conviction in some of those mega trends and some of those tech stories only strengthens here. So the combination of artificial intelligence companies and the biotech companies that, again, are at the forefront here is what I would be looking to buy on pullbacks that we see.
Jeff, where do you think the market, and when I say the market, it could be bonds, stocks, is right now on expectations for how severe this recession is going to get and how long it lasts?
Yeah, I think it's a function of trying to understand what the path of the reopening looks like. And I think most of the consensus views on the path of the reopening are the optimistic views, the base case views that you flatten the curve, you can reopen, there's a small second wave, but it's manageable because the healthcare system, the treatments are more advanced. You can use localized distancing and quarantines to manage that. And that what you don't end up with is a much more debilitating second wave. That gets the economy slowly reopening. And the kind of recovery that you get in that environment mathematically looks like a bounce back. But the real question in the bounce back is how much output was permanently lost. That there's a large degree of both permanent loss and then permanent change in behavior. That's very hard to ascertain. The other thing I would make a point on is that with the amount of liquidity injections that we're seeing in financial markets, across financial markets, that the recovery that you see in financial markets or the shape of that may be very different. It may not be actually a reflection of the anticipated recovery in the real economy because of the effect of the liquidity injections, and that you get a little bit of a different message between the financial market recovery and what we eventually get from the real economy.